Hello, today is Thursday, September 4, 2025. In this video, we will examine the intricacies of a dynamic SPX 0DTE options trading strategy that utilizes the day trading GPS SPX daily key levels indicator. In this video, we'll be going over how to use the indicator to identify high probability long and short trade entries using SPX 0DTE call and put options, establish effective stop loss levels, and secure profits with strategic targets. Okay, so on the chart we have today's session, the Thursday, September 4, 2025 session for SPX, and this is the main SPX CBOE index. And the way that this indicator works is that at 9:30 a.m. Eastern market open for the index, the levels are generated on your chart, and the main level that you'll see here is the SPX bull bear key price level, which today was 64.5767. This is the indicator's main bull bear pivot that it's determined for this particular session. The levels above the bull bear key price level are primarily used for take profit on long plays that are triggered from an entry signal that is bullish given from this level. The levels below it are primarily used as take profit levels for a bearish entry signal that would be given at triggered by this bull bear key price level. The main levels are S1 through S6 and also R1 through R6. The table here will show you all of the levels. This table is optional. You can turn it on and off. In this case, we have it turned on and we have it on a small size. You can also increase the size or decrease the size to your liking if you'd like to have it displayed. You can also change the color scheme of the table if you prefer a different color scheme. Okay, you also see these midpoint levels here. These midpoint levels are for a couple different purposes. One purpose is for setting standard stop loss levels from a level that the entry is triggered from. So in the case of an entry being triggered from the bull bear key price level, which we will refer to later on in this video as the BBKPL. So on a bullish entry triggered from this level, your standard stop loss is the first midpoint level below, which in this case for today is mid BBKPLS1 64.5122. If we instead have a bearish signal for entry triggered from this bull bear key price level, then your standard stop loss level is the first midpoint level above the BBKPL, which in this case is mid BBKPL R1 and today 64.6412. Okay, so as far as a tight stop loss level for right now with this indicator, you will have to do those manually if you want to use a tighter stop loss for your risk profile. I would recommend that you use the standard stop losses. However, many of our subscribers to the indicator have told us that they want us to come out with an update that will auto plot the quarter levels. So we're going to be coming out with an update that will auto plot the quarter levels above and below each level. This update will also have some other features and enhancements added to it besides that, and will be coming out in the near future. For right now, in utilizing this indicator, if you want to use the tight SL instead of the standard, then you just simply add the midpoint level and the BBKPL together, divide by 2, and that would equal the quarter level. So in the quarter level above, you simply add these two together, divide by 2, and that would be this. For a tight stop loss below, you simply take this first midpoint below, add it to the BBKPL, and divide by 2. Okay, so here we have the 9:30 opening candle here. As you can see here, we sort of have a candle of indecision because it closed right in the middle and the body is hardly noticeable, unlike these other ones here. So that's truly a candle of indecision. However, this strategy calls for, if it crosses below and closes below the bull bear key price level, then you take a bearish entry, which in this case would be a put option. So in this case, the put option that you would be using is the closest strike to the BBKPL of 64.57.67. That could be either the 64.55 put or the 64.60 put. The way I like to do things, if the price is above the mid, so in this case, midpoint between 64.55 and 64.60 would be 64.57.50. This is 64.57.67. It's slightly greater than half, so I'm going with the 64.60 put. However, you could also use the 64.55 put since it's so close if you're more inclined to do that. On this entry, the buy on the close, this is a 2-minute chart, and this is the 9:30 candle. So at 9:32, when this candle closes, the entry price on this was $12.30 per contract. So it's advisable to wait until, even though you saw that this candle was moving below, it's advisable to wait until the candle close to make the decision, because then it'll be evident whether it's closed below or closed above. In this case, it closed below, so that's a bearish entry signal, so we're going with the put option. Your standard SL is the first midpoint level above the BBKPL, which is mid BBKPL R1, 64.64.12. As you can see here, just a few candles later, it did touch that level, so we're stopped out. And on this particular stop out, the price was $9.10. You'll see later when we look at the Thinkorswim option charts that on the stop out we're taking the lowest price of the candle. It is possible that you could have gotten stopped out at a price that could have been higher than that, but for our purposes here, we're going to go with the lowest price, in other words, the worst price of the stop out candle, which is $9.10. If you use the standard stop loss, then your loss is $320 per contract on this because you paid $12.30 and you got stopped out at $9.10. Okay, as you can see here, after the stop out, we have choppy action here. So we have a lot of candles that are just formed between this midpoint level here and the BBKPL. So when you see something like this happen when utilizing this indicator, after you've taken a loss here, you want to make, especially after taking a loss here where you got stopped out, since we have choppy action, you wait until a successful retest of the BBKPL before entering another trade. What that means is a retest of a close above or below the BBKPL followed by a retest of that level. Okay, so what exactly does that mean? Well, here you see that it crosses below. So what that means as far as waiting for a retest is we're waiting for this level to be retested, meaning coming back up and then falling away from this level again. That would be a successful retest for another bearish entry. However, in this case, we did not get that. We got a close below. We went up. It closed slightly above it here. It closed above here. And then we have the successful retest here. The successful retest is at 10:28 a.m. That's this candle here. You also, if you wanted to get in early, since this did close slightly above it here, you could have gotten in here if you wanted to. and consider that also a retest. However, typically you'd like to see a little bit better retest than that, since this really didn't push very far above it. This one did. Then, as you can see, we got a reversal, which is almost the mirror image of this, and then we have this candle here. That is the successful retest of this level. Okay, so this candle here is the 1028 candle. This candle here is the 1024 candle. So that's 1024, this red candle is 1026, and this is 1028. So here we'd be buying on the successful retest. We would be buying the call option now, since this is a bullish entry signal. And again, we're going with the closest strike to this. Since we used the 6460 put here, we're going to use the 6460 call. If you use the 6455 put here, then when this scenario come up, then you would just pick a 6455 call. In this case, we're using the 6460 call, and we're buying on the close of this candle at the 1028 candle, which closed at 1030. The entry price on this, on the close of the candle, is $8.30 per contract. Your standard stop loss on this bullish play is the first midpoint level below, which is the mid BBKPL S1, which is 64.51.22. Okay, as you can see here on this particular entry, it did not ever breach the BBKPL again and continued its trajectory upward. So since it did not breach this, the tight stop loss as well as the standard stop loss were never in jeopardy. As you can see here, it hits the R1 level. When it's gone up one level, that is a point at which you can then make an adjustment to your stop loss. At that point, if you'd like to adjust the stop loss to the BBKPL, or just simply adjusting your stop loss to the amount that you paid so that your stop loss is break even. So again, when it moves up one full level, that's when you make an adjustment to your stop loss, if you would like to do that. And if you did that, you either adjust it to break even, which would be the same price you paid for the option, or if using it by levels, then you could just move it, for example, to the BBKPL, which would be moving it up a half level. Okay, so here at 1154 on this candle here, it touches the mid R1 R2 level of 64.7702. The 6460 call is now $18.20 on this candle close. You paid $8.30, so your profit on this is $990 per contract. Here at 1:50 p.m., which is this candle here, the 6460 call is now $24.40 on this candle close. This is when SPX now hits the R2 level. So with this indicator, you would like to exit your contracts when price has moved up 2 full levels. If you would like to get out early, you could at the mid R1, R2 level. That would be a 1.5 level move, but it's advisable that in most cases that you wait until it hits a full 2 level move. Because in most cases it will hit a full 2 level move on about 90% of trading days. On about 15% of trading days it will move beyond that, as it did in this case, moving to 2.5 levels or 3 levels or more. At this point though, you would, when it's gone to hitting full 2 levels above, you would exit all of your contracts, or if you're trading multiple contracts, such as, for example, 4 contracts, 5 contracts, or more, you could sell 75 to 90% of those contracts, and of course that would depend on how many contracts you're trading. If, for example, you're trading 4, you sold 3 of them, that's 75%. If you're trading 5 and you sold 4 of them, that's 80%. If you were trading 10 and you sold 9 of them, that's 90%, or 8, which would be 80%. So this would primarily be if you're trading multiple contracts and you're trading more than, say, 4 or more contracts. Then alternatively, at this point, when it hits a 2-level move up, and you have a 2 levels worth of profit, if you do not want to close out all contracts and you're trading 4 or more contracts, then what you can do is instead sell 75 to 90% of those contracts, adjust your stop on the remaining contracts, and leave those as runners to see how far up it may go. Because there are days where it does happen like this, where it will go to R2, mid R2, R3, it will go to R3, and in some cases all the way up even to R6. Nobody really knows that. Every day is different. There's also news that can come out, but in most cases at this point you would either especially if you're trading only 1 or 2 or 3 contracts, you would get out of all of those. If you're trading 4 or more, then you have the option of getting out of 75 to 90% of them at this point, and then adjusting your stop loss further. By adjusting your stop loss further on the runners, what that would mean is moving it up to at least another level here or another level here. If trying to adjust your stop loss by levels. If not adjusting it by levels, then you would want to adjust the stop loss on your remaining runners so that you still have a nice profit should that stop loss be hit. So what you're trying to do is you're trying to give it still some room to breathe, but if it starts going back down and reversing and going back down, say from where the last leg was, then you would like to be out. Since you already, and if you had those runners, like I said, if you happen to get out here, if it started reversing, then at least you got 75 to 90% out at the full 2-level move price, and you still made a profit on the remaining runners. In this case, that did not happen. Price moved sideways, and then towards the end of the day moved up further. Okay, so at this point, when it hits the R2 level at 150, that 64.60 call is now 24.40 on the candle close, and the profit is $1,610 per contract. That's the difference between 24.40 and your entry of 8.30. If you did happen to leave any runners, then at 3:52 p.m. SPX hits the mid R2, R3 level. One thing with runners is that you also have to keep in mind that as time moves on, if we did get a sharp move down to the end of the day, these will lose a lot of value fast because there's really no more remaining time. So just keep that in mind as far as setting what your new stop loss is going to be, especially if you're setting it at a certain price level on any remaining runners. But in this case, if you did leave the runners at 3:52 p.m., it did hit this level here. You would close out the runners here, and at that point, this 64.60 call option was $36.60 on candle close, and that's a profit of $2,830 per contract. Keep in mind that on SPX index options that you can hold them into the close. If you do hold them into the close, you will be paid cash for them, because that's the way they're settled is a little bit different from SPY options. So for example, if you held it all the way into the close, then you would be paid the difference between the closing price of SPX and your strike price. So that's also an option you have with any runners. However, typically, because of wild swings that can happen up and down in the last especially 5 minutes of the session, it's advisable that if it does hit a new target level on your runners, that you just go ahead and close it out. That works best over the long haul, even though in some cases like today it would have worked out better had you held it into the close. Okay, so another thing I'd like to go over here is late day lotto plays. So the lotto window starts at 2 p.m. and runs to the 4 p.m. close. So we have the 2 p.m. here. As you can see here, we got out of our contracts here. Unless you did hold some runners, you were out right here. So that's just after, excuse me, that was just right before the lotto window started at 2, because this was at 150. So starting at 2, you could look at some potential opportunities for lotto plays. So the lotto option strategy on SPX is it starts at 2, it runs till 4 p.m. But generally you want to enter any lotto plays before 3:40 p.m. to 3:45 p.m. hits. So your true window as far as entry is going to be 2 p.m. to 3:45. The lotto play rule is basically that you only use up to 10% of your previous session net profits on any lotto play you are considering entering, as there's a high chance they may go to 0 before the end of the session or at the end of the session if you hold them into the close. But they are lotto plays, and they can also give high returns of anywhere from 4x to 10x. In some cases, on some days, you'll see them run as high as 20 or 30x or even more. So that's why they're called lotto plays. They are high risk, high return. Since they are high risk, that's why you would only use up to 10% of your previous session net profits. So as an example, let's say here you had a profit of $1,610 a contract. You had a loss of $320 a contract earlier. So basically you have around $1,300 in, or actually $1,290 as far as net profits. So you would have up to $129 available for lotto plays if you were just trading one contract. Of course, if you were trading 10 contracts, instead of a $1,290 profit, you'd have a $12,900 profit, and you would have up to 10% of that, which would be $1,290 to consider putting into potential lotto plays. Okay, you also have to keep in mind with lotto plays, as far as a stop loss, you would use the same methodology as we had down here. So let's say as an example that you wanted to do a lotto play towards the end of the session off of this R2 level for continued bullish momentum upward. So in this case, you would either pick, and you would really just have to look at the prices and also how much money that you have in your 10% kitty to work with. Generally, the out of the money options are going to be much less expensive, so that's probably in most cases what you'd be looking at. So you'd be looking at strikes from, say, 64.95, which is the closest to this mid R2 R3 level, down to 64.85. So you'd be looking at 64.95 or 64.90 or 64.85. And in that case, if you're going to use a stop loss, then if you're doing a tight stop loss, it would be the first quarter level below R2. If you're using a standard stop loss, it would be the first midpoint below R2. However, keep in mind that with lotto play options, another option besides using a stop loss, let's say that you found an out of the money option that was, say, the 64.95 or the 64.90, and let's say that you had $200 to work with, and you could buy either one option for $2 or two options for $1, so your total is $200. Another option besides utilizing a stop loss with those is that you could go with no stop loss and just consider that your stop loss is just basically the debit of the $200 you're putting in, and you're willing to risk that $200 for the opportunity to perhaps make $800 to $2,000 or more. But if you do use a stop loss, like I said, it's the same methodology. So bullish entry off this level here, you would either use the first quarter level below as your tight stop loss, or the first midpoint level below as your standard stop loss. And that would really work from any level on a bullish or bearish entry. On bullish entries, it's going to be quarter level below for tight, or first midpoint level below for standard. If instead this was a bearish play off of R2 and we were looking at price action and we thought it was going to return back down towards the end of the day, then our tight stop loss would be the first quarter level above R2 for that put play for a move back down, and a standard stop loss would be the first midpoint level. Okay, so now before we look at the P&L for the day recap, we're going to take a look at the Thinkorswim option charts as I mentioned earlier. Okay, so here we have the 6460 put option chart. This is the 0DTE option for today, Thursday, 9/4/25. Here's the 9:30 entry candle here. As you can see, it opened at 11.9, had a high of 14.2, a low of 11.65. What we're buying on the close is $12.30. Again, we're waiting for the close for the entry, because until it closes, you can't be sure if it's going to close above or below the bull bear key price level. So therefore, even if it crosses below, we have to wait until the candle close for confirmation. Okay, so here's the stop out candle here at 9:36 a.m. As you can see here, if you remember, we used the low of this candle, so that's the worst case scenario, and that is $9.10. So we bought for $12.30 and we're stopped out at $9.10. Next, we're going to look at the 6460 call option. Okay, here we have the 6460 call option. Here we have our 10:28 entry. Remember, that was after the 10:24 a.m. candle popped above the BBKPL, and then 10:28 a.m. is our successful candle retest. Again, we're buying on the close of the candle. The close of the candle was $8.30. Here is the 11:54 a.m. candle here for this call option, and this would be when SPX hits the mid R1, R2 level. And here on the close of that candle, now the option is $18.20. And here's where you'd be exiting all of your contracts if you're trading 1, 2, or 3 contracts, or you would have the option of getting out of 75 to 90% of them and leaving runners if you're trading 4 or more contracts. And that is at 1:50 p.m. when it hits the R2 level, and now we've moved up full 2 levels from our entry. As you can see here, the close of this candle is 24.40. If you did leave any runners and adjusted your stop loss on the remaining runners, then here at 3:52 p.m., if you remember, that is the point in which SPX hit the mid R2, R3 level, and at that point on that close, this call option is $36.60. Alright, so now we'll go back to the main chart again. Okay, so we're back on this main chart again, and now we're going to look at the P&L for the day recap. So the first trade was a 6460 0DTE put option. Entry price was $12.30. We got stopped out at $9.10, 320 loss. The second trade was the 6460 call option. The entry was $8.30. When it hit mid R1, R2, it was $18.20 per contract at $9.90. On the R2 level hit full two-level move, it was $24.40 per contract. Profit $16.10 per contract. Close out 100% of contracts on two-level move, or trading multiple contracts can close out 70 to 90% of them and adjust stop and leave runners. If you did leave runners, then later on when it did hit mid R2, R3, we were up to $36.60 a contract, which is $2,830 profit per contract on any runners. The net on the day, not including any runners, is $12.90 per contract. That's taking $1,610 profit on the two-level move, subtracting the $320 loss. That's $1,290. If you're trading one contract, that's $1,290 net profit for the day. Of course, that's before any commissions. So you might have, it just depends on your broker, whether your broker charges you commissions or not. Alright, so on 3 contracts, that would be $3,870 net profit for the day. Here, instead of doing 4 through 10, we're doing 5 and a 10. So on 5 contracts, that would be $6,450 net profit for the day, and on 10 contracts, $12,900 net profit for the day. And of course, this asterisk here just simply means that on these 5 and 10 contracts do not include any profits, any additional profits from runners left after the R2 level hit. So these figures here are just from closing out all the contracts at that R2 level move. Okay, so thank you for taking the time to watch this video. If you're interested in purchasing this indicator to use in your own trading, we can reward you for watching this video by giving you a discount promo code to use when you go to whop.com/SPX indicator. So that's WHOP.com/XPX indicator. If you look in the description of the video, you will see a link with that URL that you can utilize. Before going there, though, send us an email at daytradinggps@gmail.com and request a discount promo code for the indicator, and we will send you a discount promo code that you can use on your purchase. One thing I would like to stress is that I did mention earlier on in the video about we are going to come out with an updated version of this indicator that will have several enhancements and new features, one of which was the auto plotting of the quarter levels, and then there will also be some statistical features for back testing trades and other features as well that will be added that I'm sure that you'll find to be very beneficial. When that new version of the indicator comes out, the price will be going up substantially, and that is why I can stress to you now that if you are interested in this indicator, that you go ahead and purchase it now, especially with the discount promo code that you can get on top of the current price, because you will get the indicator with lifetime access and also with the benefit of being entitled to receive any updates or new features that we release in new updated versions of the indicator as time goes on. So if you buy now, when the new version of the indicator comes out later with some new features and enhancements, and the price goes up, you will get that at no extra charge, and you've already paid a lot less by paying the price that the indicator is at now, especially with the discount promo code that we can send you. That update will probably be coming out in sometime between 3 to 5 weeks from now, and anyone who has purchased the indicator previously will automatically receive an update in an email telling them to look in their TradingView account for the new version of the indicator, and then we'll be making several videos on how to utilize all of the new features in the updated version. Alright, so thank you for taking the time to watch this video today. If you do like this video and would like to see more, please subscribe to our channel, and I appreciate you taking the time again to watch the video, and I wish you much prosperity in your future trading endeavors.